Mhm.
So this is another Thirsty for Knowledge Thursdays, a weekly webinar series brought to you by the Aries Foundation for Financial Education, Inc. And just want to make sure that everybody is part of the right flight this evening. Tonight's topic that we're going to be talking about is reverse mortgages. And we're going to go through a little bit about exactly what is a reverse mortgage, how does it work, and maybe who it might work for, or things you should consider or look at if you're trying to get one. All right, so this is really the pros and cons of a reverse mortgage is what we're going to be talking about, but we want to talk a little bit about the why, right? Why has reverse mortgages come on this, not so much come on the scene recently, but I think, Craig, that's not how they look at inflation. So things are getting more expensive. Most senior citizens find themselves living on a fixed income, whether that is Social Security and a pension, whatever the case may be, is that generally it's fixed and it really isn't keeping pace or growing at the same rate as inflation or the cost of those goods. For a lot of seniors, the number one goal was always, I want to pay off the mortgage. I don't want to have a mortgage when I'm in retirement, right? Right? Equity, that is money that's built up into the home that you now no longer have access to until you get out of the home, right? That's really what it comes down to, is that the equity is in the property, and it's not until you actually get out of the property, you can't get at it. The only way is really the two common ways prior to what we're going to talk about here, that to get equity out of the property is you have to ask for it. You either had to downsize or you had to get another loan, i.e. a home equity line of credit or a home equity loan to access the equity in the property. And there's downsides to both of those. In the case of downsizing, you've got to be ready to move.
That's if I even want to go.
Well, right, but that's what I'm saying is the only way, if you're going to downsize, that's the way to get it. And then, there's costs involved with that. There's costs with selling, there's costs with buying, there's costs with moving, there's costs with, getting everything together. All of that factors in that am I really trying to do this, and do I want to do it? Like Craig said, do I want to leave the house? And then absolutely the biggest risk to it is, what if it's a bad market? And then you go to home equity, right? So home equity, it's a line of credit, right? It's a loan. You've got to pay the loan back. You've got to get qualified for that, which can be troublesome, and you may not be able to get it. And then the last one is, if you're not able to pay it back, or you stop making the payments on it, you risk foreclosure, and then you've got to be moved out of the property. And technically, the full actual term of reverse mortgage is called a home equity conversion mortgage, an HECM. That's technically what it is, right? Yeah. It is a home equity loan, so it works just like a home equity loan like we just talked about, except for you never have to pay it back. As long as you are alive and still keeping that home that HECM is attached to as your primary residence, then you never have to pay it back. All right, so things about a reverse mortgage that maybe you didn't know. Well, one, that it's a loan, right? So I'm not sure that that's clearly ever expressed to everybody, or how it's expressed, even though the word mortgage is in there. It technically is a loan, even though you're not making payments like you do with a mortgage or an equity line. It is a loan. Yes, they are federally insured. HUD does back the reverse mortgage, so there is government backing to the process. All right, so what is a reverse mortgage? Like we said, it's a loan that provides you with access to the equity in your property, because as we talked about, if you are equity rich but cash poor, it doesn't do you any good to have all that equity built up into the home if you're trying to then go out and spend the money someplace. So how much can you get, right? So there's three factors that are involved when they look at how much they're going to give you. One is the home's appraised value. Now here's the age. The older you are, the more you're going to qualify for from a percentage standpoint. Interest rates, right? Where interest rates are will also affect how much can you get out of this. So if you're looking at a home that qualifies for the max, that's 625,000. And let's say because of your age and where interest rates are, that you could qualify to get 60% in a reverse mortgage. Well, that would be 375,000, right?
Absolutely.
So one of the first things there is that there's no prepayment penalty, right? So you can take this loan out. Let's say you only took out 50,000 for a loan, and then you decided like a week later, like that's not for me. I don't like the idea. I don't want to do it. I want to pay it all back. There's no prepayment penalty, right? It's a non-recourse loan. And the big factor here is that that means that regardless of how much you qualified for, that and how much interest gets assessed on that note, that the amount of money that's paid back cannot be more than what the home value is. That financial assessment goes along with it, which is your ability to handle that, as Craig was just talking about, being able to pay that, handle it. The other is you have to be 62. You can't be younger than 62. 62 right now is the minimum age that you can be to qualify for a reverse mortgage. Federal insurance and the backing that's involved with the federal government, but that there are limits on the origination fees, but we'll talk about that because you can do anything you want with the money. It's yours. There's never any qualification on what you can use it for. But these are different ideas or different ways that it gets done or gets paid out. So one of the things that Craig and I talk to everybody about with income, a specific retirement, is setting up and having different buckets of income. Your Social Security, your retirement accounts, maybe there's an investment or savings account, and really trying to have these different buckets to be more efficient with how you're actually generating your retirement, as Craig said, your retirement stream of income. Well, one of the other ways is having another bucket that really is not affected by any of that, right? Where it's not worrying about the swings or movement of the market. And one of the ways that we try to set up with folks is to do that through a permanent life insurance and building up cash value that way. But as it says here and shows you that one of the other thoughts is using, like Craig just explained, that reverse mortgage, the equity in the property as that stream of income. The first one, as I mentioned earlier, that the closing costs are higher than a normal mortgage, and they get rolled into the loan. One of the things that comes up is, will a reverse mortgage affect your Social Security? And the answer is no. So Social Security is Social Security. That's a separate program, has nothing to do with this. However, if you are on some other government program or benefit program, i.e. Medicaid or Supplemental Security Income, SSI, then yes, having or taking funds from a reverse mortgage could affect your eligibility for a needs-based government benefits program. The home, your spouse, or some other family member could be at risk when you take out a reverse mortgage. But in some cases, you're talking about senior citizens getting access to large sums of money. If you get, and that's why we were saying, not taking it in a lump sum, because getting it in a lump sum does sort of open you up to the idea of, wait, I'm getting this big chunk of money, and then suddenly you're ripe for somebody coming in, scams and fraudsters and all of that stuff. So, all right. So does it make sense? So it does if you're planning to stay in your home for a long time. You have to maintain all of those expenses. We beat that up a little bit here with it, right? So who shouldn't consider a reverse mortgage? That would be single seniors who are in need or soon to be needing assisted care, because more than likely you are going to be moving out. And the same thing with married seniors where both of them are needing care, because more than likely you are not going to be staying in the house that long, and it's going to become due.
Okay.
All right, so a quick review on these, right? The pros, you can access your home equity in a way that you probably wouldn't be able to do it without leaving the home or qualifying from the bank. You can age in place. This money is tax-free. There's never any taxes due on any of it or what you spend. It's federally insured, so you're not going to lose it in terms of that. And you can use the funds when you want for what you want. The cons, as we talked about, it can be expensive, those origination fees on the loan. If you have other benefit programs that you are qualified for, you do risk losing those. You can put the home at risk, as we talked about, right? It can use up, if this is the inheritance, if this is what I was going to leave to my kids or leave to my family, that's going to chew away at all of that equity that's there. And if you have other family members other than your spouse, if you're both on the note, who are actually living in the home, they may not be able to, they won't be able to stay there unless they can pay off the note.
Like if you have a failure to launch situation.
Yeah, absolutely.
So 2 quick questions before you move on. I'm
Oh,
sorry.
yeah. All right, go ahead.
2 quick questions. So if I am paying interest, just like when I pay my interest in my mortgage now, is that tax deductible?
That's a good question. I don't know that. I don't know, Craig. I'd have to look that up. So you can
Okay.
table that and we can get back to whoever asked the question in terms of dealing with that, because honestly, I don't know the answer to it.
And would the expenses to actually close the loan, same question, also be deductible? I would assume yes, but I don't know that for sure.
Correct. Yeah, I don't know. And I think that has to do with how you're actually filing your taxes nowadays, right? You know, in terms of taking the standard deduction and whether or not you can actually do that as part of it.
Well, the only reason I asked that question is because that could actually be another way to offset some income as a strategy, if you can write off the.
Right. Possibly, if you could do it, right, in terms of going through that. I don't know that it would work out in terms of the number, but it's certainly worth taking a look at.
Mhm.